When getting a mortgage, you have to decide whether you want to go with a fixed rate or a variable rate. It's important to understand what they are so you can make the most informed decision. Before we get into this video, I ask if you can like, subscribe, share this video with a family member or friend, as it will help my channel grow and reach more Canadians who are looking to learn about the mortgage and real estate industry. So one of the biggest decisions homebuyers need to make when going through the mortgage process is, would you rather a fixed or variable rate mortgage? It's important to have an understanding of each because they have such a big impact on your mortgage. So in this video, I'm going to be going over what is a fixed rate mortgage and what's a variable rate mortgage, giving you a full guide to help you make the most educated decision when it's come time to make that choice. So first off, what's a variable rate mortgage? A variable rate mortgage means that your rate is going to fluctuate throughout the term of your mortgage in accordance to prime rate fluctuations. There are two types of variable rate mortgages, one with a static payment and one with an adjustable payment. The first is the static payment. If you have a static payment, it means that if prime goes up and down, your payments won't change. You have the set payment throughout the term of your mortgage. What does change is the percentage that goes towards interest and principal. So when the prime rate increases, a bigger percent of your mortgage payment, your set mortgage payment, will go towards interest and less towards principal. And when prime rate decreases, that means more of that set mortgage payment is going to go towards principal and less towards interest. So rather your payments changing as prime fluctuates, your amortization changes. So the risk associated with getting a static payment is if rates go too high during the term of your mortgage, you may hit your trigger rate. Your trigger rate is the rate at which you're no longer covering any principal and all of it's going towards interest. So you're not paying down your principal at all. That's kind of like what we're seeing right now. Rates were super low. If you locked into a low payment static rate and rates have continued to climb like we're seeing right now, some people are getting close to hitting that trigger rate. Now the second variable rate type is an adjustable payment. Now adjustable payment just means that as prime rate increases or decreases, your payment will either increase or decrease. So as I mentioned above, variable rates are based off of the prime rate. But what makes the prime rate move? So the prime rate is based off something called the overnight rate. The overnight rate is the rate at which big banks use to lend money and borrow money to each other on the overnight market. So as the overnight rate increases, it now becomes more expensive for them to borrow money, meaning they have to increase the rate at which they're lending out the money, also known as a prime rate, to keep their margins. So now you're probably wondering, if the prime rate's attached to the overnight rate, what makes the overnight rate move? So this is a big topic to talk about. I'll probably be making a video just based off the overnight rate fluctuations, but I'll give you a short little Spark Notes version. So the Bank of Canada has control over the overnight rate, and they use the overnight rate to influence the economy. It's one of the biggest tools used for the monetary policy of the Bank of Canada. So the Bank of Canada meets 8 times a year to discuss if they'll increase the overnight rate, decrease it, or keep it the same. And this decision is based off the current state of our economy. For example, when the economy is struggling, the Bank of Canada will decrease the overnight rate. This makes debt more affordable and easier to qualify, and it gives Canadians more money in their pocket because not as much of their income is going towards their mortgage payment if they were in that variable rate mortgage. The goal is to increase economic activity and kind of kickstart the economy into growth. Whereas if the economy is growing too quickly, the Bank of Canada would increase the overnight rate. And they're pretty much trying to do the opposite of what they did with decreasing the overnight rate. They want to decrease economic activity, so when Canadians' budgets get tighter with increases to the overnight rate, they don't have as much spending money. Debt is more expensive, it's harder to qualify. So this all decreases the demand in our economy, trying to slow down the economy. So for example, right now, inflation's super high and rates have been increasing rapidly over the past year. This is because the Bank of Canada is trying to control inflation. So now let's go over the pros and cons of fixed versus variable rate mortgages. So first we'll do the pros of variable rate mortgage. The first pro is that over a 25-year amortization, historically variable rate mortgages have performed better, meaning they've been cheaper. Another pro of going with a variable rate mortgage is that the penalty is normally smaller to break your mortgage than a fixed rate is. See, with variable rate mortgages, you're most of the time getting charged a 3 months interest penalty, whereas if you're going with a fixed rate mortgage, to break that, you'll either get charged 3-month interest or interest rate differential, whichever is greater. So there's the potential of your penalty being quite sizable with fixed rate mortgages. So another benefit of variable rate mortgages is you have the option to lock in to current fixed rate market fixed rates if you don't like where the direction that the prime rate is going. So right now, a lot of people are contemplating locking into fixed mortgages rather than variable rate because they want to protect themselves against future rate increases. And then another pro of variable rate mortgages is you get the instant benefits when rates decrease without having to refinance. Because like I said, when prime rate decreases, so does your payment. Some cons of a variable rate mortgage: you don't have protection from rate increases, as if prime increases, you automatically have to pay more if you're an adjustable payment. And the risk is always there that rates will go higher. And then you don't have a constant payment if you're an adjustable variable rate. If you're in a static, you do, but you don't have that constant payment month over month. So sometimes it can make budgeting harder. So what's a fixed rate mortgage? This one's much easier to explain than variable rate. It's you have your fixed rate locked in for the term of your mortgage. So if rates increase, you aren't paying more, your payment's the same, and your rate's the same. If rates decrease, you're not paying less. Your payment's the same, and your rate's the same. So the pros of a fixed rate mortgage: you have that security from rate increase protection. Like I said, if rates increase, you're not paying that higher rate. You're locked into your payment. You know your payment month over month, making it easier for people who are trying to budget. That's what a lot of people like about fixed rate mortgages. And then you get a peace of mind knowing that if rates are going up, your payment's not increasing. Now, cons of a fixed rate: over a 25-year amortization, they've been more expensive compared to the variable rate mortgage. Again, you have to pay a lot of the time a higher penalty because there's that potential of getting charged an interest rate differential penalty. So this can make fixed rates less flexible than variable rates. And you miss out on interest rate decreases if rates drop while you're locked in for your term. So should you go with a fixed or variable rate mortgage? This is a question you should really be asking yourself based off your risk tolerance, your future plans and goals. First off, your risk tolerance. If you're the type of person who's gonna be up at night worrying about rate fluctuations and, oh my gosh, I might be paying a higher rate next time the Bank of Canada meets, then maybe a fixed rate mortgage is the product for you, just for that peace of mind. Your future plans. If you know you're going to be selling your house in a couple of years, you're going to have to refinance to pay for your kid to go through school in 2 years, a 5-year fixed rate mortgage doesn't make sense. You're just setting yourself up to pay that high penalty. That's why it's important to talk to your mortgage broker and make sure they're asking the right questions to get an understanding of your situation and so they can put you in the proper product. Variable rates tend to be the better option, not only because historically they've been cheaper, but also you have way more flexibility with them. Whether you're looking to refinance to put a kid through school, get equity from your house for an investment property, you want to sell the house. With a variable rate mortgage, you always know your penalty is going to be at 3 months interest. Rather than a fix that has that IRD penalty, it can be unpredictable. 60% of Canadians actually break their mortgage early, and a penalty is one of the quickest ways to erase equity you have built up in your home. And I'm sure all those homeowners weren't expecting to break their mortgage early, but sometimes life happens and situations change. So having that flexibility with a variable rate mortgage is a big advantage that many people like. So I hope this video gave you a better understanding of fixed versus variable rate mortgages. If it did, please like the video, subscribe, and share with a family member or friend. I've also created those 3 mortgage guides. Those are going to be linked in the description below. The first one is a first-time homebuyer's guide. The second is a refinancing guide. And the third is if you got your offer accepted and now you need financing. So go get those, link in the description below. If you have any questions, please ask them in the comments. I'll be sure to answer all comments. Or if you want to book a call with me directly, I linked my calendar link in the description. Go click on that and fill out a time slot, and I'll be happy to answer any questions you have.